Credit cards are sold as essential tools, pieces of plastic designed to help you rack up points and build a financial identity. Yet for many, a single missed paycheck means choosing between paying for groceries and covering the minimum payment required to keep their accounts active. This instability is a feature, not a bug. The U.S. credit card system mirrors a casino, where the rules are calibrated to ensure the house always wins over the long term. When you carry a balance, your monthly payments stop purchasing goods and services. They become a fee paid to the bank to maintain a debt you haven't yet settled. Breaking this cycle requires looking past the marketing and understanding the specific interest mechanics that keep these balances on the books. Banks generate their most consistent profits from users who leave a balance on their cards, rather than those who clear their statements every month. The primary mechanism for this profit is minimum payment math, a formula designed to maximize the time you spend in debt. This chart shows the scale of the challenge. On a $5,000 principal, a typical $25 minimum payment is barely a fraction of the total. In this scenario, the $25 covers the interest accrued over 30 days. Because the payment doesn't exceed that interest, the $5,000 principal remains exactly where it started. Over time, even with regular payments, the balance can actually grow as interest compounds faster than you can pay it down, with that $5,000 debt ballooning towards $6,000 or $7,000. Minimum payments allow the bank to collect interest on that same principal indefinitely, turning a one-time purchase into a permanent monthly expense. Paying off the balance while still using the card is like trying to bail water out of a boat while the hull is still taking on 100 gallons a minute. To make progress, you have to stop the inflow. This means halting all new credit card spending immediately to ensure the principal doesn't increase further. Once spending stops, you can use a 0% APR balance transfer to pause the interest. This graph shows how the compounding curve flattens into a horizontal line, meaning every dollar you pay now goes directly toward the principal. However, these transfers usually charge an upfront fee of 3 to 5% of the total balance. If you don't clear the debt before the promotional period ends, the interest rate can jump to 25% or higher, often applied to the remaining balance. Use the 0% window as a temporary shelter to reduce the principal as quickly as possible before the standard rates return. With the interest paused, you need a systematic way to attack the remaining balance. The snowball method focuses on behavior and momentum rather than interest rates. This diagram lists debts from smallest to largest. By paying off the smallest balance first, you eliminate a monthly bill and a creditor from your life in the shortest amount of time. Closing that first account provides a sense of progress that makes it easier to stay committed when tackling the larger, more intimidating balances. For those who prefer purely mathematical efficiency, the Avalanche method is the alternative. In this version, debts are sorted by interest rate. You target the card with the highest APR first. This reduces the total amount of interest you'll pay over the life of the debt, though it may take longer to hit zero. Success depends on your temperament. Choose the method that you can realistically stick with until the final balance is cleared. Credit card debt is the predictable result of a system built to capture payments and compound interest over decades. By applying the mechanics of the snowball or avalanche methods, you can systematically reduce the principal until the bank no longer has a claim on your monthly income. Which strategy aligns with how you think about money? The momentum of the snowball or the math of the avalanche? Let me know in the comments. When you understand how the house edge works, you can stop playing their game and start keeping your entire paycheck for yourself.